I think it's interesting. There is a MBA student from Indonesia, his name is Fidi Hermawan, who made a mind map related to corporate finance from Professor Roy's Sembel, and it's interesting to watch. So just go straight to his video.
Welcome guys! Welcome guys to IPMI campus. So this is ENMOY YouTube and we would like to explain about the mind mapping from Fidi. Now let's check it out. Okay guys, welcome back to me from the ENMOY channel. And my name is Fidi Hermawan, and now I would like to fulfill my task in the final task about describing my mind mapping corporate finance with Prof. Roy Sembel that I got his class for several weeks and I'm really interested, and I would like to share you the big mind mapping about the corporate finance. So let's don't further ado, we deep in more about the corporate finance. As you can see, there are three big things actually about the corporate finance in financial management. First is internal factor that will explain about the basic management, investment, restructuring corporate, external factor that will explain about the investment, and extra miles that will elaborate about fraud risk, leverage, buyout, and international finance. Now, let's talk about the basic management. Basic management has a 3-point that about principal agent, good corporate governance, 4 cornerstone of corporate finance, and we will deep in more about these things. First, principal agent problem. Principal agent problem basically is a conflict in priorities between a person or group and the representative authorized to act on their behalf. And an agent may act in a way that is contrary to the best interest of the principal. The principal agent problem is varied and as the possible roles of principal and agent. It can occur in any situation in which the ownership of an asset of a principal delegates direct control over that asset to another party or agent. There are several notes that I took from this class. First, the principal agent problem is a conflict in priorities between the owner of an asset and the person to whom control of the asset has been delegated. The problem can occur in many situations, from the relationship between a client and lawyer to the relationship between stockholder and a CEO. And the third, the risk that the agent will act in a way that is contrary to the principle. Best interest can be defined as agency cause. Resolving a principal agent problem may require changing the system of reward in order to align priorities of improvement that the flow of information or both. Now we would like to talk about the good corporate governance. Corporate governance is the system of rules, practice, and process by which a firm is directed and controlled. Corporate governance essentially involves balancing the interests of a company's many stakeholders, such as shareholder, senior management executive, customer, supplier, financiers, the government, and the community. Since corporate governance provides the framework for attaining a company's objective, it encompasses practically every sphere of management, from action plan and internal control to performance measurement and corporate disclosure. And the note is corporate governance is the structure of rules, practice, and process used to direct and manage a company. A company's board of directors is the primary force influencing corporate governance. Bad corporate governance can cast doubt on a company's operation and its ultimate profitability. Corporate governance covers the area of environmental awareness, ethical behavior, corporate strategy, compensation, and risk management. The basic principles of corporate governance are accountability, transparency, fairness, responsibility, and risk management. I will explain more after this. But before that, I would like to explain what is the benefit of corporate governance. First, good corporate governance creates transparent rules and control, provide and guidance to leadership, and aligns the interests of shareholders, director, management, and employee. It helps build trust with investor, the community, and public official. Corporate governance can provide investor and stakeholder with clear idea of company's direction and business integrity. It promotes long-term financial viability, opportunity, and returns. It can facilitate the rising of capital. Good corporate governance can translate to rising share price, and it can lessen the potential for financial loss, waste, risk, and corruption. It's a game plan for resilience and long-term success. So we would like to talk about the principle of corporate governance. While there can be as many principles as company believe make sense, some of them, the more well-known, include the following: transparency. The board should provide timely, accurate, and clear information about such things as financial performance, conflict of interest, and risk to shareholder and other stakeholders. Accountability, the board must explain the purpose of a company's activities and the result of its conduct. It and a company leadership are accountable for the assessment of company's capacity, potential, and performance. It must communicate issues of importance to shareholders, of course. Responsibility, the board is responsible for the oversight of corporate matters and management activities. It must be aware of and support the successful ongoing performance of the company. Part of its responsibility is to recruit and hire a CEO. It must act in the best interest of a company and its investor. The fourth, risk management. The board and management must determine risks of all kinds and how best to control them. They must act on those recommendations to manage them. They must inform all relevant parties about the existence and status of risk. The last is about fairness. The board of directors must treat shareholder, employees, vendor, and communities fairly and with equal consideration. Now we are going to the fourth cornerstone of corporate finance. This is good material actually. I would like to explain more about this because there's no disputing that values in defining metric in a market economy. When people invest, they expect the value of their investment to increase by an amount that sufficiently compensate them for the risk they took, as well as for the time value of their money. This is true for all types of investment, including bonds, bank account, real estate, or company shares. The cornerstones are intuitive as well. For example, most executives understand that it doesn't affect a company values whether executive stock options are recorded as an expense in a company income statement or cited separately in the footnotes of the financial statement, because cash flow doesn't change. Executives are likely confused when it takes more than a decade of bickering over the accounting rules to reflect the economic of this option. First, we talk about the core of value. A business value is driven by its growth and return on capital and resulting cash flows. Second, the conservation of value. Value is created when companies generate higher cash flow, not by simply arranging investor claim on cash flow. The expectation treadmill, movement in company share price reflect change in the stock market expectation, not just underlying performance. The value of a business an absolute, but rather depend on how you managing it and the strategy pursued. That's all about the best owner. Now we are moving on to the investment. Investment analysis is a broad term for many different methods of evaluating investment, industry sector, and economic trends. It can include charting past return to predict future performance, selecting the type of investment the best suit an investor need, or evaluating individual securities such as stock and bond to determine their risk, yield potential, or price movement. First, we talk about the NPV, or net present value. It's the difference between the present value of cash flow and the present value of cash outflow over a period of time. NPV is used in capital budgeting and investment planning to analyze the profitability of a projected investment or project. Now we talk about the ERR, or the internal rate of return. It's a metric used in financial analysis to estimate the profitability of potential investment. ERR is a discount rate that makes the net present value of all cash flow equal to zero in a discount cash flow analysis. Now we talk about the PI, or the profitability index, alternatively referred to as value investment ratio or profit investment ratio, describe an index that represents the relationship between the cost and benefit of a proposed project. Payback period, the payback period is the length of time it takes to recover the cost of an investment or the length of time an investor needs to reach the break-even point. Shorter paybacks mean more attractive investment, while longer payback periods are less desirable. Now, we would like to more about the restructuring corporate. Corporate restructuring is the process of reorganizing company management, finance, and operation to improve the efficiency and effectiveness of the company. Change in this area can help a company increase productivity, improve the quality of product, service, and reduce costs. As you know, there are several things that we learn in restructuring corporate. First, capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. Now, we talk about the external factor. As you know, this is the good material too. Let's talk about the investment. And first thing that we would like to explain about the time value of money. The time value of money is an important concept, not just for individuals, but also for making business decisions. Companies consider the time value of money in making decisions about investing in new product development, acquiring new business equipment or facilities, and establishing credit terms for the sale of their product or services. A specific formula can be used for calculating the future value of money so that it can be compared to the present value. As you can see from the chart, from the calculation, when FV means the future value, PV it means the present value, E it's I the interest rate or the return that can be earned on the money, T it's mean like the number of years to take into consideration, and then it's about the number of compounding periods of interest per year. Now we are moving on to the risk return trade-off. What is risk return trade-off? The risk-return trade-off states that the potential return rises with an increases in risk. Using this principle, individuals associate low level of uncertainty with low potential return, and high level of uncertainty or risk with high potential return. Now we are moving on to the other analysis. For example, first is the technical analysis. Technical analysis is a trading discipline employed to evaluate investment and identify trading opportunity by analyzing statistical trends gathered from trading activities such as price movement and volume. Unlike fundamental analysis, which is attempt to evaluate a security value based on business results such as sales and earning, technical analysis focus on the study of price and value. Now we talk about the fundamental analysis. It measures a security intrinsic value by examining related economy and financial factor. Intrinsic value is the value of an investment based on the ensuing company's financial situation and current market economic condition. And next, the last, we talk about the financial ratio. Financial ratio analysis is the technique of comparing the relationship or ratio between two or more items of financial data from a company's financial statement. It is mainly used as a way of making fair comparison across time and between different companies or industry. Now we are going to talk about the extra miles. Fraud management. Fraud is an intentionally deceptive action designed to provide the perpetrator with an unlawful gain or to deny a right to a victim. Types of fraud include tax fraud, credit card fraud, wire fraud, securities fraud, and bankruptcy fraud. Fraudulent activity can be carried out by one individual, multiple individual, or a business firm as a whole. So that's why we should learn about this. Now we talk about the leverage buyout. What is a leverage buyout? I give you 5 seconds to think about it. 1, 2, 3, 4, 5. Okay, we are moving on. I will explain. A leverage buyout is the acquisition of another company using a significant amount of borrowed money, bond or loan, to meet the cost of acquisition. The asset of the company being acquired are often used as collateral for the loans, along with the asset of the acquiring company. And there are several key takeaways that I note from this class. A leveraged buyout occurs when the acquisition of another company is complete almost entirely with borrowed funds. Leveraged buyouts declined in popularity after 2008 financial crisis, but they are once again on the rise. In leveraged buyouts, there is usually a rise of 90% debt to 10% of equity, and have acquired a reputation that a ruthless and predatory business tactic, especially since the target company asset can be used as a leverage against it. And now we would like to explain what is international finance. Now I will give you 10 seconds. What? Give up? Okay, I will explain. International finance, it's sometimes known as international macroeconomics, is the study of monetary interaction between two or more countries, focusing on areas such as foreign direct investment and currency exchange rates. And there are several notes about this, that international finance is the study of monetary interaction that transpire between two or more countries. International finance focus on areas such as foreign direct investment and currency exchange rate. Increased globalization has magnified the importance of international finance. An initiative known as the Bretton Woods system emerged from 1944, if I'm not mistaken, sorry, conference attended by 40 nations, 40 nations. It's more than World Cup actually, and aims to standardize international monetary exchange and policy in a broader effort to nurture post-World War II economic stability. Now we would like to elaborate what is wealth. Wealth measures the value of all the assets of worth owned by a person, community, company, or a country. Wealth is determined by taking the total market value of all physical and intangible assets owned, then subtracting the all debts. Essentially, wealth is the accumulation of scarce resources. Specific people, organization, and nation are said to be wealthy when they are able to accumulate many valuable resources or goods. Wealth can be contrasted with income in that wealth in stock and income is flow. And it can be seen in either absolute or relative term. And of course, I have note about this. Wealth is an accumulation of valuable economic resources that can be measured in terms of either real goods or money value. Net worth is the most common measure of wealth, determined by taking the total market value of all physical and intangible assets owned, then subtracting all debts. And then the concept of wealth is usually applied only to scarce economic goods. Goods that are abundant and free for everyone provide no basis for relative comparison across individuals. Unlike income, which is a flow variable, wealth measures the amount of valuable economic goods that have been accumulated at given point in time. The relative between in wealth between people are what we usually refer to in order to define who is wealthy or not. That's all about the mind mapping from the corporate finance. You know what? This is the good class that I learned so much about the corporate finance. This is all mind mapping that I already learned and what from not I got not from this. So that's all from me about the mind mapping. If you want to see more about the mind mapping in the ENMOY channel, there's many my friend that explain more maybe, or maybe they have giving some other perspective about the mind mapping. So that's all from me. My name is Muhammad Fidi Hermawan. Thank you very much, Prof. Roy Sembel, as your grandchild. No. As your student, your class is good. Thank you very much. Bye-bye. See ya.